All right, good morning, good peoples. All right, here's a video that some of you asked for more detail when I did the one on picking ETFs, and I purposely wanted to go a little outside the Yieldmax. I've been focusing a lot on Yieldmax, and I'll continue to do my updates on, 6 different Yieldmax funds, but also I want to pursue educating and giving information out on non-Yieldmax fund families. So the ones that I have here, and then I wanted to give you some detailed information because somebody in my last one said, well, can you tell us returns? And again, whenever you talk about returns, it opens a whole dialogue in terms of what people are really looking for. So let's dive in here and I'll explain that. So Defiance. Okay, so there's 6 funds that I'm talking about. QQT isn't yet paying, right? So they have a current price, but it's not really relevant because they haven't paid a dividend. And I have similar down here when I get to rec shares. The other thing that I thought was important, because a lot of people ask, I haven't needed it, but people say, well, can I get a payer the first month, the second month, the third month, fourth month, right? So if you're a YouTuber and you're trying to help people and that's what they want, then I want to give you the data that you're looking for. So I made notes in here. Separately, I think in my other video, I touched on how you could construct a first through fourth week, because it turns out that most of what I'm doing here are all fourth week, except for Defiance. Now, understand, when I got into Curve, I did 2 Yieldmax analogies. I have a point I want to make. So just understand that I'm really not reviewing Yieldmax here, except when there's an overlapping single stock fund that does exactly what another fund does. So I did that for Tesla and TSLP, and I did it for AMZ and AMZP, both showing you how sometimes Yieldmax underperforms and how sometimes Yieldmax overperforms. And the same could be said for Curve. So when is Curve better and when is Curve worse? And I'll talk to you a little bit about that. Same, I didn't in rec shares, but in Roundhill I had the opportunity because they have a more longer established BTC fund than Yieldmax's Young 2 payout YBET. So let's jump in here with the relevant information. Okay, so IWMY, a lot of you have owned it, some of you still own it. So I do want to talk about my categories. So I labeled it NAV, gain, or loss. In other words, what did I buy it for? And am I ahead of the game or am I behind the game, right? So if you bought it at inception, and I have that data far out on the right that's not showing, but you can look it up, right? It's not so much relevant to what the inception is, although again, everybody in here are monthly payers except for the orange, right? We have 2 QDTE and XDTE funds that pay weekly, so I color-coded them, right? So when I say 15 here, it means they've had 15 weekly distribution. Everything else is monthly payers, right? And I would deem this category high yield, right? So IWMY is a Russell 2000, right? Writing covered calls. And again, I differ with some people's interpretation. So ROI to me, and in most people, is nothing more than the yield gain, right? How much money did they pay me and what did I pay? So your ROI is going to be different than my ROI or somebody else's ROI unless we all 3 bought on this date and still hold it, right? So I'm simply using the date and I'm dividing it by the total paid to give me that particular number, right? So I have 8 payments totaling $8.73. So it's not too hard to say, hey, it's probably paying like 809, right? That would give me 872. I'm sorry, 109, right? So that one's an easy math number to look at. But here's the downfall, guys. And so I personally don't seek ROI because I hate it when my NAV goes down. So in this case, there's a 32.04% drop, right? Somebody bought it at inception. 9 months later and 8 payments later, it's $13.83. There's no way to disguise that. You can talk about ROI all you want, but if you leave out how much have you lost, because what if you sold it tomorrow? That's a real loss. Now, I do relate this sometimes to real estate, right? I go out and I buy a piece of real estate and I put it in the rental market, and if the market goes down 20% or 30% for the sale, maybe days on market go from 45 days to 6 months and nobody's buying homes. Well, I plan to rent it for 10 or 15 years, but if my rents go down, that's a whole separate thing. And I think all of you can relate. Anybody that was in Tesla, they saw as it was $40 when you bought in. It was really $20, but with a 2-for-1 reverse split, you have to say what was your actual acquisition cost if you bought it 20 months ago, right? At launch, it was 20, and then they cut your shares in half. So now you have half the amount of shares you had before, and it's worth, say, 17, right? You still have a $23 drop in that, right? So that's what constitutes the big NAV gain or loss. So anyway, I just want to make that point because other people may present data other way. And listen, I'll give you this if you love ROI only. You do get the use of that money, right? If I got 8 payments totaling $8.73 a share, and it's been distributed for 8 months, I can do a lot of things with that money, right? But I didn't want to make this drip-based, right, and have to do the math all around the drip. I mean, certainly I could do one of those, but for that sense, this doesn't count dripping, right? So you had a 43% gain, which is a nice gain. And are you still ahead? Yes. But don't tell me how this is better than a 50% yield or a 50% total return, because it's not. It's a lot better than another stock that has a 43% ROI and a 35% gain, right? Sorry, I meant, so everybody can accept some NAV. If I'm getting 100% yield and I do it 1 year, 2 years, 3 years, 4 years, and I'm 30% behind on my NAV, I think I can live with that, right? I'm 70% ahead because of my ROI was 100%. So there's a lot of things to take in place, but when I look at just 8 payments and I'm down 32%, no one likes it. But that's why I wanted to differentiate how I'm presenting the data. I'm literally taking this number and I'm comparing it to what was spent, and I'm calling that ROI. And my total return literally is taking this number, adding this, and then subtracting how much I lost, right? Or another way is take 1512, add 647 to it. So now I have 2169 and take away what I paid for it, 19.6. Now I have total return. And that's really the math behind creating it. Okay, so I like Defiance Fund. So I like this oil fund, right? Because I see oil prices over time going much higher. If we really head into recession, and who knows that, then I think we could see less demand. But with all the ESG movements, they really haven't incentivized the big oil companies to drill. And with all the AI and all the electricity really being needed by the global population and the emerging countries needing more and more and more energy, right? As they start to have the things that the first world countries have, that demand is going to continue for quite some time. So I'm bullish longer term on that. So you got SPY-T on the S&P 500, right? That's had 4 payments. The oil one has had 2 payments. If you care, and I like it, although it's not a high income, they have a 2x, 2 times leverage called URAX, which is uranium. I'm very bullish on uranium going forward. So all the big utilities, right, for baseload power, I see spot prices going up tremendously. I see the price of yellowcake going up a lot. And you know, what a nuclear reactor pays is like 1/10 of 1% for the yellowcake. So they've got billions of dollars investing in bringing a nuclear reactor online, 10 years to build it and plan for it. So just because the underlying fuel or minerals they need to run it goes up 50 or 100%, they hardly notice it on their sheet. They have no choice. They have to pay that. So anyway, I won't belabor you with all of my, information on that, but I wanted you to understand how I did it. So here's Aptly and Apple, right? So I wanted to introduce you to Curve. So Curve pays the 4th week of the month. To me, Curve is a Yieldmax that pays less money, and I can explain why, and I'll give you an example of where it really helps you. Okay, here's the perfect example. So I took a Yieldmax fund and I took a Curve fund. They both hold the same underlying. They both covered, well, I'll differentiate here. In Curve, some of their stocks underlying, they actually do the same methodology as Zega does for Yieldmax. They deploy a synthetic. Okay, where they differ in their synthetic, they still write, you still buy a call, sell a put, both long stock bullish. However, on their naked calls that they write on a weekly basis in Yieldmax, typically Curve goes out a month. A little more conservative because you can collect more if you do 4 weeks than you can in a month. But guess what? You don't get run over so quickly. So if the underlying goes up 30% in the week and the call was written at 8%, not only did you get capped, but you took a lot of your synthetic, if not all of it, gains to buy that back. Instead of collecting the 6 million, whatever the number is, 1-2% yield, you had to spend 8%, 10% to buy it back, because when you run it over by large percentages, it kills you, right? I mean, you still have the synthetic, but the other reason that I'm about to do, by the way, a forensic accounting review of Tesla when it went down and came back up and why it underperformed so poorly. That is an area that Yieldmax is vulnerable on, okay? Rapid declines with rapid surges back. They won't participate very well in that scenario. Okay, we all know sometimes you want to own the underlying, right? Sometimes, heck, you want to own the 2x the underlying. So this is a prime example of some of that. Look at this. So the TSLP took a 1.32%. Now, granted, they didn't start at the same time, guys. I'm not going to give you facts and try to lie to you on the facts. Right, there's 8 months of distributions here and 19 months. But regardless, if you look at the chart, okay, you should be performing closer because Tesla went way down, right? The underlying Tesla went from 300-ish to 220-ish again. You can look up the number on the chart and see when you bought it, but now it's back at 240. But regardless, your underlying is still 57% underwater, okay? Now, thank goodness, and the income is there, you now have a 2.3% gain. But I can tell you, most of you didn't get into high-yield companies to hold something for 19 months and make 2.3%. That's your real gain, okay? Now, you're a lot better off than the person who paid 35 equivalent for or bought at 20 and cashed out at 5 and said, I want to stop the bleeding. I give credit to those that hung in there because I personally think Tesla has a long way to go on the upside. Do I think it's going to pull back short term from this run to 246? I do. It could revisit 220. But am I near term and longer term bullish on Tesla? And Tesla, absolutely. But I'll also deploy some other methodology than just Yieldmax because they are vulnerable to mass moves up. If you look at this last run up, right? Granted, we took the dollar out after ex-dividend, okay? But it doesn't reflect the gain that took place on Friday or Wednesday, right? The Wednesday after market and end of Friday. It just simply doesn't because it can't keep up with those kind of runs. We all know that, but I'm just pointing it out for people that chase yield only and then later complain, oh, well, my NAV is way down. Guys, you can expect that sometimes with Yieldmax. It's just, it goes with the turf. Okay? They don't do as well when they rapidly rise, and they don't go down as much when the other stock goes down. But I'll tell you, they still get a lot of the downside. They just get the income part that helps them. But when it turns and runs back up, they don't participate in it. Near, right? So you have to consider other alternatives. All right, I don't want to beat it. So look at Amazon, though. There's a classic case of the good Yieldmax, right? You had it for 11 months. Here you had it for 8 months. So their distribution, you know, they bought it at different prices, right? So you've got only a 10% gain in the NAV of the stock. They've got a 27% gain in their NAV, right? But because you're outpaying them 2 to 1, maybe more than that, right? Because they only have 1.4, not quite 1.4 the pay cycle, right? They've got 3, so they got 3/8, 1 3/8 of the pay cycle. And look, they have much more pay here. And that's why the end result is a nod to Yieldmax at 46.6 versus Curve at 38. But I would argue, if you see a downturn coming in the market or you see something else, I think Curve has a place. Now, Curve has 6 funds only right now. And they're all kind of the big 6, right? Out of the Mag 7, except for Netflix. But they clearly, and I don't even look at the list every day. Netflix maybe be in the big 7, or the Mag 7, but I didn't think they were. Tesla's in there. And they don't have NVIDIA, right? And when you say they don't have NVIDIA, NVIDIA is the stock market right now. They're the GOAT in a lot of ways, no question. So the reason I put Yieldmax out to the side, because I've done many Yieldmaxes on this kind of tables. I just wanted you to show you the good and the bad. They tend to be conservative. Look at their Google. That's a decent, I mean, I could go and spend more cycles and show you that versus Yieldmaxes. So let's talk about REC shares, okay? Very popular fund, FEPI, right? Not to be confused with JEPI. But FEPI is a covered call, FANG and innovation, right? The Facebook, Netflix, Google, you know, all of the Amazons, Apple, you know. So it's covered calls on U.S. tech stocks. Now, I like it better when I don't see these red. I know these look real, but all of a sudden, these big numbers that look real get pulled down. And to me, total return is so valid. You can't ignore it. And then over here, I've got, you know, some average numbers in Curve, but look over here in my total return. There's nothing there, almost below 20. You know, but Apple hasn't been a great performer even in the Yieldmax fan. Okay, so we got AIPI is covered calls again with AI stocks. I don't know the overlap with AIYY. That would be an interesting deep dive, but they haven't paid yet. And by the way, the FEPI, for those of you, most of their inception, most of their stocks start at $50. But I'll say this for AIPI, I think it was June 4th. Yeah, June 4th was the launch. So they'll have a payment in July before long. And look, I could have put their, you know, their gain on their NAV gain, and it looks to be 10%, right? $5.05 on 50.05. So if I put that in there, it hasn't even paid yet, and it's got a 10% current price over its launch price on June 4th. So not bad. So these are popular, although when I say popular, for every amount of people that have them, there's somebody that owned them before. I think the popularity comes as it's a novelty, right? Who wouldn't want to get paid weekly? It's probably a nightmare for the administrative side of these funds. But again, they hire people to do all that. Yieldmax has Zega to do their options. They got title to do this. They got, a law firm. They've got an accounting firm. They got another, a strategy firm. So all of these ETF wrapper companies anymore all have many people doing many things. It's like Yieldmax. We see Jay all the time and assume Jay is the face of Yieldmax. He's a sub-advisor. And he's not even the only CEO of Zega, right? He's co-CEO. So I guess at this point, the Yieldmax people, the money people behind, don't feel any need to reach out to the public. It's just a financial operation for them. So, hey, more power to them. But it's the kind of things we see with the evolution. It's why I did my previous video on how many funds are there out there. So Curve, they rank in the top 250, 260 firms. Defiance, I think, is like number 72, 69 maybe. Rex is somewhere in that first 100. I don't have it in front of me. Roundhill is listed. I could flip back over to my list, but I don't have it in front of me. Crane is there. Oh, and so I didn't cover that. Clip, very popular fund. People love it, right? But look at this. One can argue, hey, I got a 53% ROI. They paid me $13.26. But look at this. Who wants to? I personally don't like that. $24.58 is what I paid, and it's worth $13.11. Right? I don't even like Ybit. I bought some in the 19s. I bought some in the 17s, and Ybit's 15. But all of those just finished taking their NAV out, right? And Ybit's had two $1 payment, $1.37 and $1.21. But still, if you don't watch this stuff, so what's the real yield? What's the real ROI? What's the real return on your investment? It's 7.3%, not 53%. They've handed you 53%, and they took $46.90 out of your back pocket while you weren't looking. So maybe that's why you love the ROI. I don't know. I don't love it. Okay, guys, I think that's what I got. I don't want to beat you with too much information. But this is the kind of stuff I like to do and do more of it, is bring these funds. And other people are talking. I've seen YouTubers talk on these and put them out there. And I just think it's fair because I think there's a little bit of FOMO into Yieldmax personally. And I'm seeing some of the holes. And when I expose this forensic accounting on Tesla, I'm not going to the side of the people who say they only have 15% of the upside and 100%. I'll continue to refute that and call it what it is, misinformation, disinformation, right? That's not true. But I tell you, if that underlying just really takes off, that's why you have a certain percent of your income, right, in these family of funds, and maybe you'll have some growth. There's time for 2x, right? So again, but I caution people on 2x because it's not something you want to park in and just stay there for months on end. They degrade, right? They don't hold up the 2x capability typically. So, but there's a lot of swing trading that can be done around this, and you guys ask me great questions all the time between the Discord and on my comments. Okay, I'll let you guys go for the weekend. Again, this is not financial advice. I'm not a financial advisor. Have a great rest of your weekend. Bye for now.